Welcome to the Opening Bell Report.
40%. That is the number that just kept staring back at me from this analysis report this morning.
It's a big number.
Yeah. We are looking at a stock that has been, frankly, a bit of a heartbreaker for some retail investors lately.
Yeah.
But the institutional consensus, they're looking at CoreWeave and seeing a 40% upside.
And, that 40% is really just the average. If you look at the bull case in the report, we're talking about a path to $180.
Wow.
Yeah, that's effectively a double from where it's been trading recently.
Right, but let's just pump the brakes for a second.
Right.
Because, every time I see a double your money headline, my scam detector immediately goes off.
Oh, absolutely. It should.
We're talking about CoreWeave, ticker CRWV. They've had the IPO pop, they've had all the volatility, and now they're sitting around, what, $89?
Roughly, yeah, almost 90.
And the analysis says go to 126. So the mission for our deep dive today is to unpack exactly why. Like, what are they seeing that the broader market is currently just, ignoring?
It really comes down to a disconnect between the now and the soon. The market right now is fixated on the friction.
The delays.
Right, the construction delays, the massive debt load, which we will definitely get to. But the analysts, they're looking at the engine under the hood. They aren't viewing CoreWeave as just another cloud provider.
Right.
They are classifying it as the premier AI hyperscaler.
See, that term hyperscaler, that usually gets thrown around for like Amazon, Google, Microsoft, the absolute giants. Is CoreWeave actually in that weight class? Or is this just some clever marketing fluff?
It's a different weight class entirely. Think of it like this. Amazon and Google are massive department stores. They sell everything. Storage, basic compute, web hosting, databases.
Right, they do it all.
Exactly. CoreWeave is a Formula One garage. They do one thing and one thing only, which is high-performance compute specifically for AI training and inference.
Okay.
And in this specific analysis report, that distinction is vital because the hyperscaler tag here implies they are completely stripping away all those legacy virtualization layers that really slow down on the big guys.
So they offer just straight bare metal access to the GPUs.
Exactly.
Bare metal, which is exactly what you need if you're, say, training a massive large language model and literally every millisecond of latency is costing you millions of dollars.
You hit the nail on the head. So the whole why behind the 40% upside starts with that core identity, but it's backed up by a number that is, frankly, just hard to ignore.
You're talking about the backlog.
The backlog, yeah.
$55.6 billion.
Huge.
I really want to drill into this for you listening because backlog numbers, they can be super squishy. Sometimes companies count like expressions of interest or non-binding MOUs, and they call that a backlog. Is that what we're looking at here?
No, and that's a really critical differentiator that this analysis highlights. This isn't some sales pipeline of maybes. This represents secured massive compute contracts.
Like actual signatures on paper.
Yes, these are take or pay style commitments.
Meaning the clients have to pay whether they actually use the servers or not.
Essentially, yes. The demand is so overwhelmingly high that CoreWeave can just dictate those terms. And we aren't talking about fly-by-night crypto startups renting a server rack in a basement.
Right. Who are the clients?
The report explicitly names the counterparties. We're talking Meta Platforms, Microsoft, OpenAI.
Okay, so the credit risk on that backlog is basically zero. Microsoft isn't exactly going to default on a server bill.
Right, and this provides what the analysts call revenue visibility. In the tech world, usually you are just guessing what next quarter looks like based on trends.
Hoping churn stays low.
Exactly. But with a $55 billion backlog, CoreWeave effectively has its revenue mapped out for years. It's a massive financial safety net.
But there has to be a flip side to that, doesn't there? I mean, if you have just 3 or 4 mega clients making up that entire $55 billion, you have massive concentration risk.
For sure.
If Meta decides tomorrow they're going to just build everything in-house and stop using CoreWeave entirely, poof, that backlog evaporates.
That is a totally valid concern, and the report actually acknowledges it. However, the counterargument is the sheer timeline involved. Building this infrastructure takes years.
You can't just snap your fingers.
Exactly. Even if Meta wants to move everything in-house eventually, right now, today, they are in a literal arms race. They need the compute right now. They've signed these contracts because they literally cannot build their own data centers fast enough to keep up with their own model training schedules.
So CoreWeave is essentially the overflow valve for the biggest tech companies in the world.
Overflow valves might actually be underselling it. You should think of it more as specialized capacity that the giants just can't replicate quickly enough. And that brings us to the second main pillar of this bull case.
Right, because you can have all the orders in the world, but you still need the actual hardware to fill them.
You need the chips.
The chips.
Yeah.
And specifically, we're talking about the relationship with NVIDIA.
Yes.
Now, we know NVIDIA invested $2 billion into CoreWeave. That's old news at this point. But this report suggests there's something much deeper going on there than just a standard financial investment.
It's all about allocation. You have to remember for the last 2 years, and likely for at least the next 2, is the H100s, the new Blackwell chips. They are the single scarcest resource on the planet.
Harder to get than a reservation at an exclusive Michelin star restaurant.
Way harder. And traditional cloud providers like AWS and Google Cloud, they are fighting tooth and nail for every single allocation they can get. But here is the strategic nuance that the report really emphasizes. NVIDIA loves CoreWeave.
But why? Wouldn't NVIDIA want to keep Amazon happy? I mean, Amazon buys way more chips overall.
Yes, but Amazon is also actively designing its own custom chips. Google has its TPU, Microsoft has Maya. The big tech giants are effectively future competitors to NVIDIA. They actively want to reduce their reliance on Jensen Huang. But CoreWeave, they have absolutely no interest in designing chips.
They are pure customers.
They are loyalists.
Ah, that makes perfect sense. So by pumping up CoreWeave, NVIDIA is essentially creating a check on Amazon and Google. They're funding a neutral third party to ensure the big three don't completely monopolize and dominate the cloud space.
Precisely. It's a proxy war. And because of that dynamic, the analysis argues that CoreWeave essentially holds a golden ticket for supply. When the supply chain gets tight, CoreWeave gets the call.
Which creates a moat.
Exactly. It creates a massive moat around their business. If you are OpenAI and you need 10,000 Blackwells immediately, you can't just go to Azure if Azure is completely sold out. But CoreWeave might actually have them because NVIDIA prioritized their shipment.
So the moat isn't their custom software, and it's not even really the data centers themselves. The moat is literally having the phone number of NVIDIA's allocation manager on speed dial.
In a heavily supply-constrained market, access is the ultimate moat. And that access allows them to scale at a speed that honestly seems impossible for anyone else.
Let's talk about that scale for a minute. The report mentions an aggressive expansion plan. We're talking about gigawatts here.
Yeah, over 5 gigawatts of capacity by 2030. To put that in perspective for you listening, a typical large-scale data center might draw 30 to 50 megawatts.
Okay.
A gigawatt is 1,000 megawatts. So we're talking about building the equivalent of dozens of massive power plants worth of electrical draw.
That is mind-boggling. And what are the revenue targets associated with building out all that power?
The analysis projects they will hit the $12 billion revenue mark by 2026.
$12 billion. Okay, let's do some quick math here. The stock right now is at $89. The market cap is sitting around $45 billion.
Mm-hmm.
If they actually hit $12 billion in revenue, that puts them trading at, what is that, under 4 times sales?
Just under 4 times forward sales, yes.
That seems insanely cheap. I mean, you look at Palantir, you look at Snowflake, or even the other infrastructure plays in the market. They usually trade at 10, 15, sometimes even 20 times sales. Why is the market pricing CoreWeave at such a massive discount if the growth story is so perfectly lined up?
Well, because the market isn't stupid. It knows perfectly well that projected revenue and actual booked revenue are 2 very, very different things. And this is exactly where we have to pivot to the reality check section of the analysis report.
The risks.
This is why the stock isn't sitting at $180 already.
The debt.
The debt is the massive elephant in the room.
The report explicitly says $14 billion in debt. For a company that just recently went public, that is a truly staggering amount of leverage.
It really is. You have to understand, CoreWeave is operating much more like a leveraged infrastructure project.
Like a toll road or something.
Exactly. Think toll roads or airports, not a light software company. Software companies naturally have very high margins and super low capital expenditures. You write the code once, you sell it 1,000,000 times.
Pure profit after the dev costs.
Right. But CoreWeave has to buy the physical land, build the concrete building, buy the massive cooling systems, and then buy the most expensive computer chips in human history to put inside them.
And they are doing all of this on a giant credit card, essentially.
A very large credit card with very real, significant interest payments. The analysis points out that these financing costs are already eating heavily into their profitability.
Wow.
And here's the major risk. If interest rates happen to stay higher for longer, or if lenders just get spooked by the broader market and tighten the tap, CoreWeave's entire growth engine just stalls out.
Because they need that constant flow of fresh capital to feed that 5-gigawatt ambition. If the money suddenly stops, the building stops. And if the building stops,
then that beautiful $55 billion backlog becomes completely worthless. You simply can't bill a client for a server that doesn't actually exist yet.
And it's not just about the money either, right? It's about the actual physics of the real world. I feel like tech investors so often forget that the cloud is actually a physical concrete building filled with incredibly hot metal.
Yes.
The report specifically highlights delays in facilities across Texas, New Jersey, and Pennsylvania.
This is the part that I think is the most underappreciated by the average investor, the physical execution risk. The report details very specific issues in these regions, and it's not just that construction crews are slow at pouring concrete.
It's the power grid.
It's the grid.
We're hearing this everywhere now. The power grid is just full.
Exactly. You can't just walk into a local utility office in New Jersey and casually ask for 500 megawatts. That is literally the power consumption of a small city.
Yeah.
You need to build new substations, you need high voltage transmission lines, and most importantly, you need permits.
And permits mean dealing with local politics. Nobody really wants a massive humming data center in their backyard, and nobody wants their local electricity rates to spike just because CoreWeave is sucking up all the juice.
Correct. The analysis notes that these specific physical delays in Texas, New Jersey, and Pennsylvania have really spooked institutional investors. Every single month a facility is delayed is a month of lost revenue from that massive backlog.
Just pushes everything back.
It compresses their margins and, crucially, it delays that $12 billion revenue target we talked about.
So that's the core tension here.
Right.
On one side, you have the golden ticket for GPUs and this practically infinite demand from the biggest companies on Earth. But on the other side, you have this massive debt burden and what sounds like absolute permitting hell.
And that tension is exactly why the stock is currently trading at $89 instead of higher. The market as a whole is pricing in the probability of failure. The analysts writing this report, however, are betting heavily on the probability of success.
There's actually one more factor suppressing the stock price right now that we really need to touch on. It's a bit more technical, but the report flags it as a major short-term headwind: insider selling.
Yes, this is a classic post-IPO market mechanic.
It looks really bad to the average person, though, doesn't it? You scroll through your feed and see the headlines, early investors actively dumping stock. It really feels like the smart money is fleeing a sinking ship.
It definitely feels that way emotionally, but you have to look at the broader context. Many of these early investors got in years ago when CoreWeave was literally just mining Ethereum in a garage in New Jersey.
Right.
They're currently sitting on thousands of % in gains. The IPO lockup period expires, and naturally they want to buy a house or diversify their portfolio. It's entirely rational financial behavior.
But regardless of the reason, it creates real supply on the open market.
Exactly. It creates what traders refer to as overhead supply. Imagine you're trying to push a beach ball underwater. You have to use constant force. Every single time the stock price tries to rally past, say, $90 and $95, a massive wave of these insider sell orders hits the market and just pushes the price right back down.
So even if the news that week is great, even if they announce an amazing new contract, that selling pressure just acts like a heavy lid on the pot.
For now, yes. But the analysis makes a point to suggest that this is a temporary phenomenon. Eventually, the early investors will simply run out of shares to sell, or they'll decide they want to hold on to the rest for the long haul.
And then what?
Once that overhang finally clears out, the stock can move much more freely upward based on fundamental business news.
Okay, let's try to synthesize all of this. We've gone through the bull case, the demand, the moat, and we've covered the bear case, the debt, the grid. The report ultimately lands on a verdict that the 40% upside to $126 is highly realistic.
Highly realistic is the exact phrase they used in the summary.
So what's the trigger? If I'm a listener who is already holding the stock or maybe thinking about starting a position, what am I actively watching for in the news? Is it a standard earnings beat or an interest rate cut from the Fed?
I mean, those macro factors definitely help, but the real trigger you're looking for is execution milestones. The report is very, very clear on this point. CoreWeave absolutely needs to prove they can bring a major new facility online, on time, and on budget.
They need to physically show they can plug the servers in and turn them on.
Yes. The very moment they announce that, say, the delayed Texas facility is finally fully operational and they are actively billing clients, you completely validate that massive backlog.
You prove it's real.
You prove to the market that the construction delays were just normal infrastructure hiccups, not fatal flaws in the business model. That is when the risk premium evaporates and the stock will likely re-rate.
It re-rates from that cheap 4x sales multiple to something much closer to a standard high-growth tech multiple.
Exactly. If the market eventually stops viewing them as this risky, leveraged construction project and starts viewing them as a reliable, cash-printing AI utility company, that is exactly how you get to that $126 price target.
It's so interesting to think about. We almost always talk about AI as this ethereal, purely digital revolution. Software and algorithms. But this deep dive really grounds the whole AI boom in literal dirt and massive corporate debt.
It really does ground it. It's a very physical business at the end of the day.
It actually reminds me a lot of the old gold rush analogy. Everyone always says, don't dig for gold yourself. Be the guy selling the shovels.
Right. And in this current market, NVIDIA is clearly the one selling the shovels. They have the insanely high margins, basically no debt, and literally everyone comes to them begging for supplies.
But CoreWeave isn't selling shovels at all. CoreWeave went to the bank, took out a $14 billion loan, bought literally all the best shovels from NVIDIA, and is currently trying to dig the biggest mine anyone has ever seen.
That is a perfect way to frame the dynamic.
And if they manage to hit the mother lode, which in this case is unlocking that guaranteed $55 billion, they're going to make an absolute fortune. The sheer leverage works exponentially in their favor.
Wow.
But if the mine collapses?
If the mine collapses, or even if they just can't dig the dirt fast enough to pay back the huge interest on the loan for the shovels, it gets incredibly ugly, very fast. That is the exact risk-reward profile you are looking at here.
So for you listening right now, this isn't a safe, steady savings account play. This is a high-stakes bet on management's ability to navigate the messy physical world just as well as they've navigated the digital one.
Absolutely. You are betting on the jockey just as much as the horse here. Can this specific leadership team handle the insane logistics of a multinational construction boom while simultaneously managing a highly volatile balance sheet? The analysts writing this report say yes. The broader market is still crossing its arms and saying, prove it.
And that prove it phase is likely going to be the dominant story for this stock for at least the next 12 to 18 months.
I completely agree. Anyone looking at this shouldn't expect a straight, smooth lineup. It's going to be really choppy as they navigate these local power grid issues, but the destination, if they actually get there, is significantly higher than where we are sitting today.
Well, it's certainly not a boring story. A 40% predicted upside, solidly backed by the absolute biggest names in tech, fighting head-to-head against the slow, gritty realities of the American power grid.
It's easily the most interesting battleground in the tech market right now.
We'll leave it there for today. A massive, guaranteed backlog, a golden partnership with NVIDIA, and a literal mountain of debt. That is the reality of the CoreWeave story. Thanks so much for being here and helping us break this analysis report down.
Oh, my pleasure anytime.
And thanks to you for listening. We'll be back with another deep dive very soon. Keep your eyes on the financial news, and hey, maybe go check the local commercial permit filings in Texas if you want a little bit of head start on the market. Catch you next time.
Don't forget to like, share, and subscribe for more.